Hey guys, what is going on? Welcome back to my Robinhood portfolio. Today I thought I'd talk about the distinction between income investing and growth investing. There's been a lot of new viewers on the channel wondering exactly what I mean by growth stock, what I mean by dividend or income stock, and which type of investing is best. Is growth better? Is income better? Or is a mix of the two the best way of investing? So I thought I'd do this by looking at a couple of different quintessential examples of both growth stocks as well as income stocks. And maybe a stock that is kind of in between growth and income, has characteristics of both types of investing. As you can see here, I have Amazon pulled up, and this is a quintessential growth type of stock. You can see over the last 1 year, 24.33% growth. Over the last 5 years, 284.47 with regards to overall rate of return in the price of the stock. So the price of the stock is rising very, very rapidly. Under the statistics part of Robinhood, you can see the dividend yield is 0 and the PE ratio is quite high, 239.85. So what you are looking for in growth investing is buying a stock at a low price and selling at a higher price. It seems kind of benign and kind of obvious, but you're really not taking into consideration any type of dividend yield or other types of return with the price of the stock, with the return of the stock. And the characteristics of these types of stocks are they're typically newer, developing companies like Amazon, Facebook, Google, for example. Dividend yield is typically 0 because they're taking all of the net income and putting back into the company to grow the company quicker than any dividend yield could give back to an investor. So, for example, a lot of stocks have dividend yields of 5%. They're essentially giving 5% of their price of the stock back in the form of dividend to the investor. And there's a number of different metrics that kind of evaluate what the dividend payout percentage is. But a growth stock takes all of that money, puts back into the company to grow the company faster and at a higher rate of return than simply giving back a proportion of the company's profits to the investor as a form of a dividend, if that makes sense. So you're basically putting money back into the company, growing the company, and the company grows very, very rapidly here. That's the whole point of growth investing. The company grows with regards to the stock price very, very rapidly. And the stock price is just a reflection of how large the company is. And the other key characteristic of a growth stock is the PE ratio is quite high because an investor is willing to pay more per dollar of earnings now because in the future they expect the company to have very, very good earnings growth. So they're willing to pay, for example, $239 for each dollar of earnings now for Amazon because in the future, an investor is expecting that the earnings growth will rise tremendously just as the stock price does. Another great example, a quintessential company for a growth stock is Facebook. Let's take a look at Facebook here. This even has better growth than Amazon. Over the last 1 year, you can see 33.88% growth, and over the last 5 years, 13%. So this is the quintessential growth stock. Again, dividend yield 0 and PE ratio is quite high. Another quintessential growth stock is Tesla. There we go. TSLA. Over the last 1 year, you can see it's up 56.53%. And over the last 5 years, it's quite tremendous growth here. 1,075.92%. And again, the dividend yield is 0. It says NA because actually this company has negative dividend yield. It has actually negative growth. So every year this company is losing money. You can see that here with the earnings. Q2 earnings 2017, that's in the negative. And really only Q3 2016 had positive revenue earnings. So there's really an infinite PE ratio here because every dollar you spend on this company, you're essentially spending negative earnings. You're having a loss each quarter with this particular company. But investor is willing to do that because over the long term, they think the price of this company is going to go up tremendously and the earnings will go up tremendously as well. This will become a profitable company in the future. So as you can see here, the characteristics of growth stocks, a 0 dividend yield, a very high PE ratios, and the price of the stock is expected to rise very, very rapidly versus the overall S&P 500 underlying index. On the other end of the spectrum, and a lot of the stocks I have in my portfolio are income or dividend stocks. A great example of that is PFE here, Pfizer. You can see over the last year, it's not even up. It's only at around baseline 0.76% in the red. And over the last 5 years, it's up 65.48%. But these are typically stable stocks, more developed stocks, more mature stocks. You can see the dividend yield is quite nice with this company, 3.756. And the PE ratio is typically a little bit lower than the growth stocks, 24.476%. So the characteristics behind these are they have great dividend yields, the PE ratios are lower, they're mature stocks, And they're much more stable stocks as well. These are typically dividend aristocrats, stalwarts on the S&P 500, blue chip companies. These are stocks that have long track records of great performance. But they're not going to have explosive growth. So they're a little bit less growth heavy. You're not going to be seeing a price of a stock triple, or like Google, Amazon, Facebook, getting up into the 100+% rates of return over the 5 years time span, or really even to the 1,000% rates of return with Tesla. These are mature companies, quality companies that are very low risk. Another example of this would be Abbott Laboratories here. Over the last 1 year, it's up quite nicely, actually, 18.37%. Over the last 5 years, you can see it's down a bit here, 16.41%. But it's got a great dividend yield here, 2.72%. P/E ratio on this one is a little bit high, and unclear why that is. Not quite sure if the statistics on this company are correct. And this is actually an offshoot company from Abbott Laboratories. So, or excuse me, AbbVie Incorporated is an offshoot of Abbott Laboratories. So that's what's accounting for this big price difference here. If we take into consideration that this company here was part of that company, you'd have to really add the two together. And you can see here, it just started trending essentially in 2012. This is an offshoot. So you really have to add this to the price of Abbott Laboratories. So that probably wasn't the best example there, the greatest example of showing you guys what income or dividend income stock is all about. And Johnson & Johnson, this is a great income stock here. You can see 13.7% over last year. Over the last 5 years, it is up 124.73%. But again, a great dividend yield on the bottom here, 2.734%. And the P/E ratio is a little bit lower as well, 22.25. Boeing, Lockheed Martin are great income dividend stocks as well. And telecoms are great income stocks as well. Let's go over to AT&T and Verizon. These are some of the quintessential types of stocks when you think of income or dividend stocks. They have very high dividend yields, and they pay back to the investor most of their income in regards to the net profit in the form of a dividend. So you can see over last year, kind of up and down pattern, 3.12% down. Over the last 5 years, 33.16% up. But a great dividend yield here, you can see on the bottom, 4.538%. P/E ratio is low as well, 17.929%. Verizon, another great income stock. For the last year, down a bit. Over the last 5 years, up 39.65%. But again, great dividend yield, 4.281%. And P/E ratio is 12.487%. So those are the types of investments, the different types of investment philosophies. Income on one side of the spectrum, growth on the other side of the spectrum. Growth stocks typically have zero dividend percent. They have very high P/E ratios, and they're really banking on the fact that the price of the stock will rise very rapidly over a short period of time. A little bit more risky because of that. They're newer companies, developing companies, less mature companies. On the other end of the spectrum, growth stocks are stocks that have good dividend yields, have low P/E ratios because they're very mature companies. They've been around for a long time. They are stalwarts of the S&P 500. They have very good track records of growth and investment strategies with regards to dividend income. So they're a little bit less risky. They're a little bit more conservative investments, and they're definitely good for the longer term buy and hold strategy. So those are the two different types of investing: growth on one hand, income or dividend investing on the other hand. Two different ways of playing the stock market. Each have their advantages and disadvantages. And really, in my portfolio, I have a collection of both income stocks, dividend stocks, as well as growth stocks. So I think a 50-50% proportion is very good for any investor. But again, if you're a newer investor, if you are an investor that is more open to risk, I think growth stocks are the way to go. If you're a more conservative investor, if you're a little bit closer to retirement, definitely income and dividend return stocks are the way to go. So those are the different types of investing. I don't want to make the video too long, so I'll kind of end it there. As always, if you guys have any great video ideas, let me know. If you guys like the video series, please feel free to like, share, and subscribe. Definitely appreciate the support, all the support you guys have given the channel. And again, the channel is about learning, so if you guys have any good questions, any good investment ideas, let me know. Always wanting to know about different ways of investing, new topics to read up on. Really just learn about investing. That's the whole point of this Robinhood portfolio, is to learn about investing. So yeah, again, if you guys have any great video ideas, let me know. Like, share, and subscribe if you're so inclined. And until next video, we'll see you then.